You check your bank account on a random Tuesday afternoon. You already know what you're going to see, but you check anyway. Paycheck came in 4 days ago. Rent cleared, car payment cleared, a couple of subscriptions you forgot you even had, food delivery, gas, that one small Amazon order, and somehow, without a single outrageous purchase, you're sitting there thinking, how am I almost back where I started? There's $183.47 in your checking account, and you make decent money, not broke, not reckless, just stuck. You tell yourself, I need to save more. But when you try to cut $500 a month, it feels impossible. So you do nothing. Because if you can't make a big change, what's the point of making a small one? And that right there is the flawed mental model. You've been trained to believe that small amounts don't matter. That if you're not investing thousands, it's irrelevant. That real wealth is built with big moves. Here's the thing. That belief is mathematically wrong, psychologically wrong, and financially dangerous. My name is Tom, and I spend way too much time thinking about long-term wealth building and the psychology of saving. If you're someone who feels like you should be further ahead financially but can't seem to create momentum, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Let's talk about $10 a day, not $500 a month, not $20K a year, $10. That's 2 coffees, 1 impulsive Uber upgrade, a random app subscription, half a lunch out. Most people hear $10 a day and think, that's cute. It's not cute, it's compounding gravity. Let's do the math calmly. $10 a day is about $300 a month, call it $3.6K a year. Now imagine you invest that $3.6K per year into something boring. An index fund returning, say, 8% annually. Historically, broad market returns have averaged around 7 to 10% depending on time frame. The Federal Reserve's long-term data on equity supports that range over multi-decade periods. At 8% after 10 years, you don't have $36K, you have about $52K. Pause. You only contributed $36K. The extra $16K came from growth. Now stretch that to 20 years. You contributed $72K. You end up with around $178K. Now stretch it to 30 years. You contributed $108K. You end up with roughly $447K. Almost $500,000 from $10 a day. And that's assuming you never increase it, never optimize, never earn more. Just flat, boring, consistent $10 daily. Now you might be thinking, yeah, but 30 years is a long time. Exactly. That's the entire point. Time is the multiplier, and most people treat it like it's optional. Here's what's fascinating. According to Federal Reserve survey data, a significant percentage of Americans struggle to cover a $400 emergency expense without borrowing or selling something. Think about that. $400 is 40 days of $10 decisions, 40 days of small choices. That's how thin the margin is for most people. Now look at this from a psychological angle. Humans are wired for short-term rewards. Behavioral economists call this present bias. We overweight immediate pleasure and discount long-term benefits. A coffee today feels real. Retirement in 30 years feels abstract. Loss aversion also kicks in. Giving up $10 feels like losing something. Gaining $447K in the future feels hypothetical. So your brain says, keep the $10. But that's not what's actually happening. You're not keeping $10. You're spending $447K. That's the hidden trade-off. Let me show you something more aggressive. Scenario 1, you save nothing. You invest nothing. You rely entirely on future raises to fix your financial life. Scenario 2, you save $10 a day starting at 25 years old and invest it at 8%. By 55, you have roughly $447K. Scenario 3, you wait until 35 to start. Now you only invest for 20 years. You contribute $72K. You end up with about $178K. Same $10 per day. 10-year delay. Difference, roughly $269K. That's what procrastination costs. Not emotionally, not philosophically, mathematically. And here's where it gets uncomfortable. Most people don't delay because they can't afford $10. They delay because saving feels insignificant. This is where the flawed mental model really shows up. We think scale creates impact, but in investing, consistency creates scale. Look at it like weightlifting. If you go to the gym and lift one heavy weight once a month, nothing changes. If you lift light weights consistently, over time you get stronger. Compound interest is just financial muscle memory. Now let's add another layer. Let's say instead of investing, you spend that $10 daily on something with no residual value, subscriptions, convenience, minor upgrades, $3.6K a year. Over 30 years, that's $108K in raw spending. But if you invested it, it becomes $447K. The opportunity cost isn't $108K, it's $447K, and that's at 8%. At 10%, historically closer to long-term equity returns in certain periods, that same $3.6K annually over 30 years becomes about $650K from $10 daily. Now let's dismantle some common advice. You've probably heard, just focus on earning more. Saving small amounts doesn't matter. This is half true and half dangerous. Yes, income growth matters, but higher income without saving discipline creates lifestyle creep, and lifestyle creep is a silent wealth killer. The IMF and World Bank both publish data on household consumption trends. As incomes rise, spending rises almost proportionally in many developed economies. That means earning more does not automatically increase wealth. If you can't save $10 at $50K income, you likely won't save $10 at $80K, because the issue isn't income, it's identity. Are you someone who keeps a margin or someone who consumes it? Here's another piece of advice that sounds good but falls apart. Live for today. You might not make it to retirement. Statistically, that's fear talking. Life expectancy in developed countries has consistently increased over decades according to World Bank data. The probability that you'll need money in your 60s and 70s is not small. But here's the deeper issue. Saving $10 a day isn't about retirement, it's about optionality. If you have $447K at 55, that's not just retirement money, that's negotiating power. That's the ability to walk away from a toxic job. That's reduced stress. That's freedom from desperation. Let's quantify something else. Let's say you don't invest it. You just put $300 a month into a high-yield savings account earning 4%. Over 10 years, you'd have about $44K. That's not explosive, but that's a serious emergency fund. That's a down payment buffer. That's insulation. Now imagine combining this with raises. If you start at $10 a day and increase it by just $2 per day every 5 years, so age 25 to 30, $10 daily, 30 to 35, $12 daily, 35 to 40, $14 daily, 40 to 45, $16 daily, 45 to 55, $20 daily. You're still not doing anything dramatic, but now your annual contributions gradually rise from $3.6K to about $7.3K. Run that over 30 years at 8%. You're not at $447K, you're pushing towards $700K plus. And it didn't require a lottery win. It required incremental increases. This is where psychology flips. When you prove to yourself you can consistently save $10, you're not building a portfolio, you're building self-trust, and self-trust compounds too. Most people don't lack information, they lack consistency. They bounce between extreme saving and extreme spending. They try to cut everything, burn out, rebound, repeat. $10 a day is small enough to be sustainable, but large enough to matter. Now let's zoom out globally. Central banks like the BIS publish long-term data on inflation. Over decades, inflation erodes purchasing power steadily. If inflation averages 2 to 3%, your cash loses value quietly every year. If you do nothing, your money shrinks. So the real comparison isn't saving $10 versus spending $10. It's investing $10 versus losing purchasing power. Standing still is moving backward. Let's take another scenario. Two friends. Alex spends $10 daily on convenience for 30 years. Jordan invests $10 daily for 30 years. At 55, Alex has experiences and memories. That's fine. Jordan has $447K plus the ability to generate income from that capital. At 4% withdrawal, that's nearly $18K per year without touching principal. That's $1.5K per month in optional income from $10 decisions made decades ago. Now think about stress. According to Federal Reserve reports on household financial well-being, financial stress correlates strongly with lack of emergency savings. Stress impacts health, productivity, relationships. So that $10 per day isn't just future wealth, it's future stability. Here's where most people sabotage themselves. They wait for motivation, they wait for the right time, they wait for a bigger paycheck, but compounding does not care about your feelings. It cares about time. Every day you delay, the exponential curve flattens. Let me show you the most painful math of all. If you invest $3.6K annually for 10 years at 8%, you get about $52K. If you then stop contributing and just let that $52K sit for another 20 years at 8%, it grows to roughly $242K. Your first 10 years did most of the heavy lifting. That's how non-linear this is. Early dollars are worth more than later dollars. They have more time under tension, like muscles in a gym. Now imagine you delay 10 years and then invest $3.6K annually for 20 years. You get about $178K. So starting early and stopping beats, starting late and doubling the duration. Time is leverage. Here's the perspective shift. Saving $10 a day is not about deprivation. It's about redirecting tiny leaks. You're already spending it. The question is whether it becomes temporary dopamine or permanent capital. Look, I'm not saying never enjoy your life. I'm saying build the engine first, because once the engine is running, it starts funding your freedom. And the irony, once you see the account growing, it becomes addictive in a different way. You shift from consumer dopamine to progress dopamine. You start asking, well, where else can I find $5, $10, $20? Not from scarcity, from momentum. And here's what happens if you do nothing. You wake up at 45 with minimal investments. You realize retirement calculators say you need 1 million plus. You panic, you try to save aggressively, but now time isn't your ally, it's your enemy, so you take more risk or you accept lower expectations. All because $10 felt too small to matter. Disciplined people win, not because they're smarter, but because they respect small numbers. They understand that $10 is not $10, it's a seed, and seeds look insignificant until they're trees. If you're watching this and you're 22, you have absurd leverage. If you're 32, you still have meaningful leverage. If you're 42, you still have agency. The math changes. The principle doesn't. Start with $10. Automate it. Remove the decision, because the decision is where your brain sabotages you. Make it invisible. Let compounding do what it has always done, and then increase it gradually. The real power of $10 a day isn't the $447K. It's the identity shift. You become someone who invests daily, someone who prioritizes the future, someone who builds margin. And margin is power. I want you to think about where you are right now financially, not where you wish you were, not where you pretend to be. Where you actually are. How much are you investing monthly? How much are you consuming unconsciously? Be honest, because this isn't about shame. It's about trajectory. $10 a day can change your trajectory. Quietly, boringly, powerfully. If this reframed things for you, hit the like button. It helps more than you think. And subscribe if you're serious about thinking long term. Drop a comment and tell me where you're starting from. Income range, savings rate, age. No judgment, just data. Because disciplined people who understand small numbers end up with big options. And that's the game. I'll see you in the next one.